Hello and welcome. Today we're diving into the world of Indian taxes. Now, I know, that might sound a little intimidating, but trust me, the way the system is set up, this idea of paying tax as you earn, is actually a lot simpler than it sounds. We're going to demystify the whole thing.
So let me kick things off with a question for you. Do you think income tax is just a once-a-year thing where you pay one big lump sum when you file your return? It's a super common assumption, but it's not actually how it works. The government's whole approach is to collect tax throughout the year, bit by bit.
Okay, so here's our game plan for today. We'll start with that core concept, pay as you earn. Then we'll get into the two main ways that happens, TDS and advance tax. After that, we'll look at what happens if you don't do this. And we'll wrap up with a handy checklist to keep everything straight. Sound good? Let's go.
Right, so the entire Indian tax system is really built on this pay-as-you-earn philosophy. And to make that happen, it rests on two massive pillars that make sure taxes get paid during the financial year. The first is tax deducted at source, which you probably know as TDS, and the second is advanced tax. Let's start with that first pillar, TDS. Now, this is the interesting one because it's the tax that's paid for you. The person or the company that's paying you, whether it's for your salary or a service you provided, is the one responsible for cutting the tax part and sending it straight to the government on your behalf. So, to put it formally, TDS is just an amount that the payer deducts from what they owe you. This could be your salary, interest from a bank, or even rent. They take that slice out and deposit it directly with the government, all in your name. You can think of it like a down payment on your final tax bill, except someone else is making it for you. And TDS is everywhere. You'll see it on so many types of income. If you've got a regular job, your employer is already deducting TDS based on your tax slab. If you have a fixed deposit that earns you over 40,000 rupees in interest, the bank is going to slice off 10% as TDS. And oh, check out that last one. If you win more than 10,000 rupees in a lottery or a game show, a whopping 30% is deducted as tax right then and there. It's not just for day-to-day income either. TDS applies to bigger, more significant transactions too. For example, if you're a freelancer and you bill a client for more than 30,000 rupees for professional fees, they're supposed to deduct 10%. And look at this, it even applies when you buy property. If it's worth over 50 lakh rupees, 1% gets deducted as TDS right at the source. All right, let's make this totally crystal clear. Let's use that lottery example. Imagine your lucky numbers finally come up and you win 1 lakh rupees. Amazing, right? But you're not actually going to get a check for the full 1 lakh.
Why? Because, as we saw, the TDS rate for lottery winnings is a flat 30%. So the lottery company is legally required to immediately deduct this exact amount, 30,000 rupees, as tax.
And here's where it all comes together. The lottery company sends that 30,000 rupees straight to the government for you. You get the remaining 70,000 in your pocket. That 30,000 rupees is now sitting as a tax credit against your PAN number, which you'll claim when you file your final return. Pretty straightforward, right? Okay, so that was TDS, the tax that's paid for you. But what about all the other income you might have where no one is deducting tax? Well, that brings us to our second pillar, advance tax. And for this one, you are in the driver's seat. This is the pay-as-you-earn tax that you have to manage yourself. So advance tax is basically for any income where TDS hasn't already been taken care of. Instead of waiting until the end of the year and getting hit with a massive tax bill, the idea is to pay it in installments as you actually earn the income. It's a win-win. It helps you manage your cash flow, and it gives the government a steady stream of revenue. So who needs to worry about this? Well, the rule is pretty simple. First, you estimate your total tax for the whole year. Then, you subtract all the TDS that's already going to be deducted for you. If that leftover amount, the tax you still owe, is 10,000 rupees or more, then yep, you need to pay advance tax. There is one important exception though. Senior citizens over 60 who don't have any income from a business or profession get a pass on this. And here they are, the dates you absolutely need to remember. There are 4 deadlines throughout the year. By June 15th, you have to pay at least 15% of your total estimated tax. By September 15th, you need to have paid a cumulative total of 45%. It keeps building from there. 75% by December 15th, and finally, you have to settle the entire 100% by March 15th.
Okay, theory is one thing, but let's see how this works in practice. Let's imagine a freelancer. We'll call him Mr. A. He's figured out that after all the TDS is deducted by his clients, he'll still owe the government about 2,010,000 rupees in tax for the year.
This table breaks it down perfectly. By the June 15th deadline, Mr. A pays 15%, which is 31,500 rupees. Simple enough. Now, for the September 15th deadline, he needs to have paid 45% in total. Since he already paid a chunk, he just has to pay the difference, which is another 63,000. Same logic applies in December. And finally, by March 15th, he just pays whatever's left to clear his total bill. See how it breaks a big number down into much more manageable payments? Okay, so now we know how to pay and when to pay. But what happens if you don't? This is where things can get pretty serious. The government doesn't mess around, and there are specific penalties and interest charges if you don't follow the rules for TDS and advanced tax. Now, for anyone who is responsible for deducting TDS, like a business owner, this is a really critical detail. If you simply forget to deduct the tax, you get charged interest at 1% per month. But if you deduct the tax from someone's payment and then fail to deposit it with the government, the penalty jumps to 1.5% per month. The government sees that as a much bigger deal. And honestly, it can go way beyond just paying some interest. The law has a term for it, prosecution, and it's used for a reason. If it's determined that you willfully failed to deposit the TDS you collected, the consequences get very, very severe. And when I say severe, I mean it. We are talking about rigorous imprisonment, which could be for a minimum of 3 months and go all the way up to 7 years, on top of a fine. That really tells you just how seriously the government views TDS compliance. For advanced tax defaults, the penalties are all about interest charges. Under Section 234B, if you pay less than 90% of your total tax bill by the end of the year, you pay monthly interest on the shortfall. Then there's Section 234C, which penalizes you for missing those specific quarterly installment targets. And of course, filing your final income tax return late has its own penalty under Section 234A.
All right, I know we've covered a lot of ground here, but we can really boil it all down to a few key actionable takeaways. So let's put together a simple checklist to help you stay on top of everything. Here you go. First, make sure you know what TDS rates apply to your specific types of income. Second, get into the habit of checking your Form 26AS. Think of it as your tax passbook. It shows you if the tax deducted by others has actually been deposited in your name. Third, if your tax liability after TDS is more than 10,000 rupees, you have to pay advance tax. Fourth, get those 4 dates in your calendar right now: June 15th, September 15th, December 15th, and March 15th. And finally, always remember the cost of being late. That interest of 1 to 1.5% for every month of delay can add up fast.
So there you have it. We've untangled the 2 core pillars of paying tax in India, TDS and advanced tax. It's a system that's really designed for steady, consistent payments, which is better for you and for the government. The only question left is, now that you know the how and the when, are you ready to take charge and plan out your financial year with total confidence?